Hey guys, Kevin Bopp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert and serial entrepreneur, Dan Hanford. Now, Dan has an extensive, successful background in starting multiple seven-figure businesses from scratch, including a large group of non-surgical orthopedic medical clinics located in South Carolina. He's also the founder of the Multifamily Investor Nation, where he educates a nationwide group of 40,000 plus members on how to properly invest in multifamily assets. In addition to multifamily, Dan is also active in a number of other niche asset classes, including express car washes, self-storage, as well as a debt fund. And so, guys, with that, it's my honor to welcome back as a return guest, Dan Hanford. Dan, how you doing, my friend?
Doing great, Kevin. Thanks for having me back. I know we were talking about when the last time it was, and it's definitely been way too long. So
I know, 3 years, man. It flies. Time flies. So so I was looking back as to when I had Dan on the show last. It was February of 2019, and so obviously a lot is going on in the past 2 years, let alone 3 years, and so excited to have you back on, my friend, and looking forward to getting an update on your business. Now, I know that you guys were doing a lot of great things back in 2019, but man, you guys hit your stride at some point over the last couple of years and just have exploded your business. And so I want to talk about that. I'm excited to kind of dive deep into what you're up to today. But, for those that aren't familiar with you, Dan, maybe just take a few moments and kind of expand upon your background a little bit and ultimately how you found your way into real estate.
Sure. Yeah. So I'm actually a chiropractor by trade. So started my first chiropractic clinic in 2011 and spent a few years there working in the clinic as a solo practitioner. And one of the things I found is that as a solo practitioner, I was pretty much working a job because I can only see so many patients in an hour, and I was capping my income. And then at the same time, if I wanted to go on vacation, I basically had to continue to pay my staff and the overhead and all the expenses, but no income was coming in. So it was a big hit to the bottom line. So I never really wanted to go on vacation at that time. So quickly learned to kind of play the CEO role and hire some people that can help, manage the clinics and also be able to see the patients so that I wasn't having to go in there on a day-to-day basis. And then a couple of years later, we ended up hiring on some medical doctors and nurse practitioners to do an integrated clinic where we had kind of a nurse practitioner or a medical and DC all under one roof. And then about a year later after that, we ended up cutting out the chiropractic services completely from the clinics so we can solely focus on the medicine that we were practicing at the time, which is non-surgical orthopedics and sports medicine, doing a lot of prolotherapy, PRP, stem cell treatments for ortho conditions, and also some basic or generic injection-based therapies for arthritic conditions. And so doing that, we expanded from one location to 4 locations across South Carolina. And we found a problem of making too much money, because when you make too much money, you got to pay a lot of money to the government in taxes. And so we actually I decided to step away from the clinics full time. I promoted our COO to the CEO so I could focus on on the real estate side of things, started investing passively first, and then also hired a mentor to teach me how to be an active investor myself, and did a few co-GP deals in the beginning. I think we did 2 or 3, and then started to acquire our own assets. And in 2018, we raised $4 million to acquire the assets that we acquired in 2014, which I'll say was probably the hardest $4 million we've ever raised. And then in 2019, we ended up raising $32 million. 2020, in the middle of the pandemic, we raised $61 million. And then last year in 2021, we raised $196 million. And then this year so far, in the first quarter of 2022, we've raised just over $110 million so far, and have just over $1 billion in assets, and probably about closer to 1.2 to 1.3 billion in acquisitions, because we did have some exits last year as well. So it's been a very fast trajectory to get to where we are today. But the goal of starting the group was to have some alternative assets for investors to invest in, that it's not just multifamily, although multifamily is our number one holdings right now. We also have self-storage, we also have hotels, and then also express car washes at the same time.
Yeah, fantastic. I appreciate that background. So it sounds like you stepped away from your practice to fix your tax problem. And ultimately,
exactly. Yeah.
I love
No,
it.
it was a big tax problem, because
Yeah.
you work all year long
Full-time
and you had to
job,
pay
right?
these large amounts in taxes. They don't remind you of it once a year. Like most people, they hit you every quarter as a business owner.
Yeah.
So every quarter you're getting these little, hits taking your money away. And now we effectively pay zero federal income tax because of all the depreciation that we have off of our assets.
Yeah, fantastic. So I want to talk about the growth. I mean, that is just a massive growth trajectory. What do you attribute, all that growth to? I mean, talk to me about how you got from 4 million. You said it was it 4 or 8 million? That
4 million.
4 million, a very challenging 4 million to raise, to 191 million last year, and then you said just in the first quarter of this year, I think you said it was over $100 million.
Yeah.
So you guys are on track to more than likely exceed what you raised in 2021. And so talk to me about that growth trajectory, and then ultimately, what do you attribute that growth to?
So I think the biggest thing that I can attribute it to is that we take care of our investors. I see a lot of people in the space around syndication where they come in, they raise money for 1 or 2 or 3 deals, and then they basically don't raise any money anymore, do any more deals. I think you've probably seen those people too. And I get a lot of their investors. I call those donor syndicators because they donate their investors to us. Because for us, we know we don't want to just do 1, 2, or 3 deals. We want to grow our wealth and our investors' wealth for many, many decades. And we want to be able to rely on our investors to be able to acquire more assets. And we have a very high success rate or very high repeat investor rate. So in every deal we put together, we're around 71 to 73% repeat investor rate. So every deal, 71 to 73% of those investors right now have already invested in a prior deal with us, and they're putting more money with us. And we do investor dinners across the country to kind of, be able to put a face to the name with our investors. And one of the things that we do is we go around the table and we ask our investors, what is it that makes you want to continue to invest with us? And the number one thing that comes in time and time again is our level of communication and transparency with investors. And in the beginning, we didn't even think that was a big deal. We were just doing it because we thought that was a great thing to do, right? Now, my wife and I are in about 65 different LP positions with about 17 different operators right now. And so I get a lot of my kind of thoughts around like what people are doing or not doing, and kind of can change things and to improve things for investors. But for us, I think the bottom line is taking care of the investors and knowing that we can't continue to grow if we don't take care of our investors. And so we always put our investors first in a lot of the things that we do.
Yeah, no, it's a beautiful thing. And so what are some of the unique things, again, you've gathered a lot of the ideas from, the many different LP investments that you're in, kind of seeing, what folks are doing right, what they're doing wrong, what they could be doing better. What are some of those unique things that you guys do now as it relates to communication with your investors? Yeah,
so every offering that we put out to our investors, we in the very front of the package of the offering memorandum, it actually has the phone number, direct cell phone numbers, and emails of everything, all 3 of the managing partners, right? Mm-hmm. So our investors know that if you have a problem or you have a question, you can reach out to us. We don't try to hide behind our team or anything like that. We're out there in the open and say, hey, reach out to us. Now, if it's a question that you think that our investor relations team or our investor services team can handle, you can ask them. But if you're not getting anywhere, feel free to reach out to us, right? And the funny thing is that I've talked to other syndicators about that, and then a lot of times they're like, "Well, I don't want investors calling me at all times of the night." And I'm like, these investors are respectful investors. Like they're not just going to call you at 10 o'clock at night, right? And if they do, you just don't answer. But I can't even remember the last time somebody called me. Most of the time, somebody text messages me and says, "Hey, I have a couple questions for you. Can we schedule a call?" Right? But I would say of the 1,800 plus investors that are active in our various deals right now, I might get 2 or 3 text messages a month, and that's it.
Yeah.
So it's not a very large amount of people because they know the process of going through the IR team and making sure that all the questions go through them. And if there's issues or problems, feel free to reach out. I'm glad to be there for you. So I would say the biggest thing for us has been just making sure that we have the ability for them to have access to us. And then we also provide proactive communication to them about the performance of the asset.
Yeah.
And so every month we're hitting them with an update on how the asset's performing.
I think you hit the nail on the head right there as to why you're not getting a million calls in the middle of the night or in any one given week or month, right? It's because you guys are proactively communicating and you're putting out just a large amount of information and keeping those lines of communication open so that they're very well aware and up to speed with what's going on with any particular investment that they've made. So, I mean, that is of the utmost importance. I mean, it's interesting because you mentioned you're in a number of LP investments. I am as well. And just the broad spectrum of the level of communication is staggering. I mean, there's a number of investments that I'm in where I'm baffled that they're doing things the way they're doing them. And maybe they've been doing them for many decades. They're an old group. And there's kind of just old school in their ways. But it's shocking to me that it's not the lack of transparency. It's just that you gotta dig, and it's really hard to get answers. And it's frustrating. It's really frustrating when there's now with technology. I mean, there's such an easier way to keep your investors abreast of what's going on. Just keep them in the loop, and ultimately it'll avoid you getting situations where you're getting 1 million calls a week or in all hours of the night. So anyway, just that's awesome. I appreciate you sharing that with me. So how about the team? Talk to me about again the growth, the capital, deploying that capital into assets. There's a lot that goes into raising capital is one thing, but ultimately being able to deploy it and effectively manage those assets. And so talk to me about the growth of the team over the last couple of years and what that looks like.
Yeah, I mean, I would say that that's definitely something that has increased over time. And, one of the things that Danny, Brennan, and myself, the three managing partners, sat down in the very beginning and decided on is that the asset management fees that we collect on each one of our assets, we don't put it in our own pockets personally. We take those asset management fees and we pour them back into the company at passiveinvesting.com LLC. And that allows us to be able to grow our team with our portfolio as it's continued to grow. So as we can acquire more and more assets, those fees, of course, are going up and up for us as far as the dollar amounts that are coming into the bank. And so we want to make sure that we can bring on team members to be able to support the growth that we have. And so in the beginning, it was really just the three managing partners in 2018. And right now, this year, we're sitting at about 37, 38 full-time team members that are on the team right now. And so there's been a tremendous amount of growth when it comes to our team, but I think it's also commensurate with the amount of growth that we've had with the number of assets that we have too.
Yeah, fantastic. And then, outside of multifamily, I know that's where you have the largest share of your investment dollars. That's kind of where you guys ultimately got your start. Now you've expanded into a litany of other asset classes. Talk to me about just the expansion phase into a new asset class that is very different than that of multifamily. You guys accelerated that growth very quickly into a multitude of these asset classes. So, were there bumps along the way? Again, how do you become an expert in a short period of time? I guess is probably the best question to ask.
Yeah, so it's funny that you bring that up because it's a question that we get from investors a lot right now because we have had such a large growth in our group. And one of the things that I learned when I was growing my medical clinics is that you have to make sure that you have a separate team for each what I would call business unit or one of those asset classes. Because when I was expanding my medical clinics, I had one location, and then I said, I want to open up a satellite location, a second location, and it was actually about an hour away from the first one. And so what I did to make sure that we were successful in the second location is I made the mistake of taking my entire core team from the primary clinic and moving them all and transplanting them into this new clinic because I wanted to make sure it was successful. And it was very successful. It was profitable within about 2.5 months in that second location. What we started noticing is that the first clinic started to drop, right? And so that's the biggest fear that investors have is that you take your focus off of what's happening in the multifamily space and you go acquire self-storage, which is what we did as far as adding self-storage, but we did it in a strategic way because of my experience and learning that from expanding the medical clinics. So what we did is we actually hired on a separate team to manage and acquire those self-storage assets. So we're not taking our focus away from multifamily. We had our largest amount of acquisitions last year in multifamily, and that's the same year that we opened up the self-storage acquisitions, right? We did right at over $80 million in self-storage acquisitions last year amongst our $450 million, if you will, of multifamily acquisitions last year. So we actually were able to still continue to grow the multifamily and the self-storage at the same time because we basically added on a separate business unit and hired a team to manage that. We've done the very same thing for hotels this year and then also the express car wash space.
Yeah, fantastic. And as far as the management, I'm assuming in the multifamily space, are you guys outsourcing to a third-party management group?
Yes, that's correct.
How are you handling the self-storage and also that of, I guess, car washes? And I didn't realize you're in hotels until we started talking here today, but does it vary depending on the asset class of how you're handling the management?
Yeah. So on multifamily, self-storage and hotels, we use a third party. The unique thing that we do with self-storage is we convert them from a manned facility to an unmanned facility. And the management company that we use specializes on that. And they have a really great track record of being able to do that. As a matter of fact, I think they had like 32 leases in one day on one of our properties recently. And it was an unmanned facility, right? Which is kind of crazy to think about. But so that's what we do with those three asset classes. And with express car washes, it's a little bit different because there is no easy button pressed for property management. So it took us about 18 months, and we had to put together all the thought process and the procedures and the processes for starting our own vertically integrated management company for car washes. And so we actually have a core team that we've built out that we own that manages the express car wash spaces, and they've been doing a phenomenal job with the locations that we have right now.
So as far as being that's in house, that's vertically integrated, are you keeping your expansion inside a tight knit radius as far as how close they are to one another, these locations, or you guys spread amongst different markets and states?
Yeah, as long as there's easy access to them, as far as either by drive time or easy access by air, then we're flexible with it, right? But right now, the core focus that we have is kind of in the southeast. So that's kind of where we are. We're all the way from Maryland all the way down to South Carolina right now. And we also have a few assets in Florida that we're looking at. We have in various stages of due diligence, but right now we're kind of from Maryland all the way down to the Carolinas.
Okay, fantastic. It's interesting because the car wash space, I feel, gone through quite an evolution over the last decade. And as I was mentioning before we start recording here, I did like an interview series or a car wash series of interviews, 4+ years ago on the show. And I brought on a number of operators of, the express car wash model, which is what you guys are building your business on today, which is it's kind of like the latest variation of car wash models that are out there. And, the old school way, which are like the full service car washes, I'd interviewed Chuck Howard from Autobell, the founder of Autobell. Their family's been in it for 50+ years. And, their locations for the most part are full service. And, it was funny because I interviewed him first and I had familiarity, just theoretically what the express model was because I had driven past them. You kind of see all the vacuums outside. But, at that point, 4 years ago when I did the interview with Chuck, we got talking about, just the car wash space and, how it's been evolving, the equipment, it's gone through many different iterations over the years and it's gotten better. But all I remember is the last time I had been through a drive-through car wash, call it 15 years ago, my car pulled in kind of dirty and it pulled out. And as soon as it dried, it looked dirty again, right? Like there was still this film on it. And so like, it wasn't really a solution. And the only solution were like the full service ones, right? Where
a detailed service. Yeah.
Yeah. I mean, you've got like some staff at the end that are wiping the water off and, you're coating the wheels with the shine and doing all that kind of stuff. But the drive-through versions, at least from times past that I remember, they just didn't do a good job at all. So anyway, after that interview, there was one of these down the road from my office that I'd driven past every day for years. I don't remember the brand, but I went down and I did. It was probably one of the earlier versions of the express car wash. And I drove through it. It was like pollen season. My car was full of pollen on the outside. It was disgusting. And I was blown away. I mean, it wasn't 100%, but it was probably like 90%, which is pretty damn good for taking 3 minutes of my time to go through it, right? And so anyway, now I'm just rambling on now, but I'm impressed by the quality of the wash that you get now from these automated systems at the express car washes that are out there. And so let's talk about the business model itself. It's a very fragmented niche, as we were, again, chatting about, as you guys are going through the acquisition phase, you guys are buying existing car washes, but also you've got ground up developments happening on a number of them as well. And so talk to me about the acquisition side of the business, the strategy, again, it's a very mom and poppy business. How are you guys building your portfolio? Is it just one-offs? Are you buying, are you able to buy portfolios of car washes from larger operators? But what does that side of the business look like?
Yeah, so it is a very fractionalized industry, like you had mentioned. There's not very many institutional players in the space. There are a few, like maybe 3 or 4 or 5, but the major players are acquiring assets. So we're competing with some of those major players, but that's the challenge when it comes to the larger portfolios. But one of the things that we're trying to do is, most of the owners right now, I would say 95% of the owners in the space are smaller mom and pop owners. They go and get an SBA loan. They build an asset, maybe 2 or 3 more assets, and then they're ready to sell. And the problem with the smaller mom and pop operators is that they don't really know how to run a business, right? And they don't know how to really put in some systems and procedures and processes. So the consistency of the car wash is not there. And so there are times when you go through an express and you get that film on it after when you're done. And a lot of it has to do with the chemical concentrations and making sure you maintain the nozzles that are coming out of the sprayers. And, all those different things are maintenance things. And a lot of these smaller mom and pops, when we acquire them, we're looking at them going, hey, they should replace this and this and this and this. And the reason why the cars aren't getting cleaned is because they're not, spending money on the maintenance items that need to actually be done. And they're basically just raking in the cash while they can. And then they just decide to sell. And I'll give you an example of also kind of what we do from an institutionalizing these car washes. Yes, we're creating consistency, but we are also going in and improving upon the monthly memberships, because the MRR, the monthly recurring revenue, is what gives us a higher equity multiple when we go to exit. And so, we just acquired 2 car washes in March of this year. And if we actually had the data from the year before, and from January 1st to the end of the year last year, they had sold around 1,600 monthly memberships the entire year. And we've now owned the asset for about 6 to 7 weeks. And we've already sold over 1,200 memberships in the last 6 to 7 weeks. And it's because they just weren't focusing on it, right? They didn't have the pay stations being manned. They didn't have the people at the pay stations, trained to actually sell the membership plans. It was just basically go through, nobody talks to them, they push the button, they go through, and that was it. And so we're trying to transform it and also allow us to be able to increase the monthly memberships. And our goal, as far as the entire business plan with this, is to acquire right at about 150 to 200 locations and be able to sell to a private equity group and a large private equity roll-up play to get a large equity multiple on that. We're talking 11, 12, 13x on the EBITDA. And then we can also at that time potentially look to, instead of selling to a private equity group, we could also potentially look to do an IPO of our own, because we'll have over $100 million a year in revenue. And so once you get to that level, usually these larger institutional players are interested in taking you on as a potential IPO. There was an IPO that happened last year, about a year ago now, from Mr. Car Wash, and they IPO'd at a $4.5 billion valuation with about 300 locations. And so there is that potential to be able to do that as well. And of course, when you do that, you potentially get the even higher equity multiple from that, maybe 15 to 20x. And so it's exciting for us, for us and our investors. I mean, these offerings, when we put them out, fill up within hours. The very first one we put out was an $8 million raise. We filled up within 2 hours. Another one we raised about $19 million, and we raised that within about 10 hours. And so the investors are liking them because they have higher cash flows. So on these, we offer a 10% preferred return. The cash flows are usually between about 10 to 15% during the hold period. Then they have the large 20, 25, 30% overall annualized returns when we go full cycle on the project. And so there's a lot of upside potential and great cash flows on these things. And then of course, we don't underwrite for the large private equity roll up or the large IPO or anything like that. So we can actually do that in the end. It's going to give our investors even a higher return once we exit these things on the other end. So it's a pretty exciting asset class, but it is very fractionalized, and we're trying to go in there and institutionalize it, acquire these from smaller mom and pops, 1, 2, 3, 4 assets, and even the portfolios of 5 to 20 locations, and be able to grow our portfolio to be able to have this nice institutionalized business that a private equity group would be really excited to acquire.
No, I love it. I love it. Are there any national brokerage groups that specialize in the car wash space?
There are. So
really? Okay.
there's probably about half a dozen or so. We were actually in Nashville. The car wash show. There's actually a convention for car washers. The car wash show is happening in Nashville this week, actually, and so we flew out there on Monday. Myself and one of our other partners, Brandon, just to spend the day there while the rest of our team stayed the rest of the week. But we flew out there to spend the day, kind of rub shoulders with some of the brokers and just meet some of the other people out there and see some of the new things that are coming out. And it's very interesting to see all the different things that are going to be coming out in the car wash space, which was some of the things that we've already talked about and are going to be implementing ourselves to try to kind of transform how they're actually run to be able to be ran more efficiently. And then it's going to be one of those things where these brokers go to be able to try to get you to kind of get on their list or whatever. We probably have, like I said, there's probably at least 5 or 6 really solid ones that are out there that it is small. So like in multifamily, you got 5 or 6 in each location, right? In each city. But here it's pretty much across the United States. There's about 5 or 6 big ones, and we're on the list of those. And so we're getting a huge amount of deal flow every single week, and it's been kind of hard to keep up, if you will, from the acquisition standpoint, because there's so many opportunities that are out there. And right now, there's not a lot of institutional people that are going after it. So you're not really competing with 30, 40, 50 other bidders on each one of the assets. But over the next 5 to 10 to 15 years, it's going to get more and more competitive, which we like, because the more competition we have when we go to sell, the higher the valuation we're going to be able to achieve.
I'm assuming. I mean, one would guess that there's really not a lot of competition from larger players at this point, because it's so fractionalized, right? I mean, there's no third party management that you can just plug and play, and so an institution doesn't want to come in and deploy 10 million here, 10 million there. They want to come in and deploy hundreds of millions of dollars in one fell swoop and actually buy an operating company that's already got the infrastructure in place. They don't have to build that piece of it. So that's a beautiful thing. And what are the downside risks? I mean, what are the risks associated with this business model? And I guess, as I kind of joked with you that just within a 5 or 10 mile radius of my home, there's I said a dozen, but I know there's 3 on one major north-south thoroughfare. There's 3 that are literally on the same side of the road within 2 miles of each other. Literally, and 2 of them are probably within a quarter mile on the same road, which is baffling to me. That one's got a hard signalized intersection, which I think is probably the better ingress egress. The other one, it's only got a one-way ingress egress, and then there's another one about a mile away from there. But is the barrier to entry is it fairly low at this point in time? Is that one of the risks associated with this business model?
The barrier to entry is low. There are some municipalities that are starting to prevent new car washes from coming into the space. But the biggest thing with being in close proximity to another car wash is the traffic count. So if it's a very high traffic road or intersection, then it can achieve the higher numbers, right? If it's in a different traffic pattern, then that's something else we have to look at as well. For example, there's an asset that we're looking at in Wilmington, North Carolina right now, and there's one on one side of the street, and right across the street is another one, and they both do extremely well. And it's because they're on 2 different traffic patterns on a super highway getting 90,000 cars a day, right? So being able to have that many cars in one location is perfectly fine to have 2 locations, because one location can't support 90,000 cars and the stickiness rate, if you will, of those 90,000 cars in one particular day. And if you look at it from a standpoint of a different business, if you've started to notice like the Take 5 oil changes and the oil change type places, they're popping up all over the place as well. And I have there's a place down here, and there's a street here in town. It's where the major mall is, and it's a major thoroughfare, and there's literally like 3 or 4 within a quarter of a mile of each other, all express oil change places. And I'm like, how do all 3 of them stay in business like that? But they've been there for 10 years. So they must be doing really well for them to have 3 different locations in the same road. And so it all has to do with traffic count, population, and the type of car wash that you're actually acquiring in there, whether it be a full service, a self-serve, or an express wash, or even a flex serve.
And are you guys solely looking at the express model?
Yes, we are. Now, we will still look at like a flex serve or a full service and then convert it to an express, but our goal is to convert all of them and have all express car washes.
What's a flex serve? I'm not familiar with that terminology.
Yeah, so a flex serve is where you actually have the express model, but then you have the option to do full service. Okay. And it's usually like an express detail. So they call those flex serve, and they're usually a little bit more capital intensive but also labor intensive.
Yeah. And how about, what does the data show as far as in hard economic times? Do people wash their cars less? I mean, how does that trend go? I mean, again, just those that are starting to pinch pennies a little bit and get a little tighter with their budget. Is washing their car one of those items that get cut out of the monthly budget?
Oh, it really isn't. Like even one of the things that has caused a lot of institutional players to start to come into the space is because during COVID, these car washes did really well, right? Because they had the monthly recurring revenue come in, which allowed them to keep the lights on and still cash flow. And then they also had people still coming in to wash their cars because that was the only thing they could do, and they got out of their house at that point too, right? Because they couldn't get out of the car and go anywhere, so they stay in the car and go to the car washes. But with the price point of the monthly fee being $20 to $40 a month, we didn't really see a large attrition or churn rate, if you will, with the monthly memberships. And so with the monthly memberships, it creates that stabilized cash flow that comes in month after month after month. And so we really, that's probably the biggest thing with the express car washes is that it has not had a true test of time with the recessions, except for with COVID. And they fared very well during COVID, which is one of the reasons why we continue to go after it, even after our research about 18 months ago, we started doing the research on it, was we know that this is a good recession-resistant asset class. Everybody always is going to have a car, whether it be a gas or electric, and they need to get it washed. And for most people, it is the most expensive item that they will purchase next to their house. And so they care for it a lot more, and they wash it a lot more as well.
Yeah, no, that's great. And so the monthly memberships, I actually use. There's a car wash near me, and I don't use it all the time, but I've probably a couple times a year. But there is a membership. I have no idea what it costs. I think I choose like the $10, whatever the $10 wash is, and when I go through it, what does a typical membership cost? Is it $20 a month? Something around that range?
So there's usually 3 different memberships. That's funny because we've bought some of these car washes, and they have like 5 or 6 different levels of memberships, and it's like, no, you need 3 levels. That's it. Exactly. So the majority of people will choose the middle one, which is very interesting. There's actually a book for your listeners if you want to research this by the name of the author is Robert Cialdini. He wrote a book by the name, it's called Influence, the Art of Persuasion. It's one of my all-time favorite books on human social psychology and getting people to do things that based on a response, right? And it's not trying to do things deceitfully, right? But it's like, hey, instead of choosing and giving them 5 options and people go, I don't know what I want, I'll just do the one-time wash today because I don't want to have to decide between 5. You give them 3 options. Majority of people will choose the middle option, and there will be about 20 or 30% that'll choose the most expensive, and 20 or 30% that'll choose the least expensive because when they look at it, they go, well, I don't want to be cheap and get the cheapest because I'm fairly successful, so they choose the middle option because they don't really want to spend the most amount of money. But then there's some people that are like, oh, I'm very successful, I can afford the biggest and the most expensive, so they buy the most expensive, right? And so that psychology is one of the things that we look at when we're trying to set up these plans. And so there's 3 plans, usually ranging between about 20 to 40, and depending on some of the markets, it might be up to $50 to $55. But it all just depends on the market and the comps that are surrounding that market as well.
Yeah, I got it. I'm guessing like the $20 and $30 models. It's almost I kind of compare it to like a gym membership, right? Like a lot of people get a gym membership, especially like the Planet Fitness model. I always thought that was such a brilliant model because it's such a low amount on a monthly basis that you just almost forget. It's almost more of a hassle to cancel it than it is just to let that money get withdrawn from your account each and every month.
Yeah.
So, anyway.
Well, that is one of the things is that you want it to be low enough that it's under the radar, so it's not as big of a deal. Yeah. And what's interesting is when you look at the data across the board, if you for the membership to make sense, if you wash your car at least twice a month, it pays for the membership, right? Because of the way the price point is. So you can go in and spend $15 on a car wash. Or you could pay $20 membership, you get unlimited washes, and if you wash it twice, you've already paid for it, right? That's kind of how we price out those monthly memberships. But the interesting data point is that most people on these monthly memberships, the average number of washes is 1.8.
That's funny.
So it's a good, and for us, the data that we look at is how much is it costing us to wash somebody else's car? And so usually the industry's kind of standard or norm is between 70 to 90 cents to wash a car. So you can see the amount of profit that is kind of there and why these cash flow so nicely. But what's interesting about our acquisitions is that we've acquired some washes recently, and the price for the car wash was like $1.40 or $1.50, which doesn't seem like a lot, but when it's supposed to be 80 to 90 cents, we can go in there and help to change the chemical concentrations, improve the flow rates, improve the amount of cars that can go through at one time, and it allows us to be able to reduce those costs per car to be able to get it in line with what the industry norm is, and be able to cash flow even better.
Interesting. And then, as far as like the typical cost to build, I mean, I know the big variable outside of just, material and labor costs, depending on the marketplace, is the land cost, right? The land is probably the biggest variable there. But outside of the land, what are one of these, the express models, what do they typically cost to erect?
Yeah, so they're usually anywhere between about $3 to $4 million to actually erect them and kind of build them to get to the CO stage, and then the land is usually anywhere between $250,000 all the way up to $2 or $3 million, depending on the location, and maybe even more. Most of the time, what you'll see is in most acquisition or most developments, you'll see the land cost being under $1 million, and then it's costing about $3 to $4 million to build. And then the cool thing about it is that we're actually putting together a car wash development fund, and all it will do is be doing development, and it'll have no cash flows, of course, during the hold period. But we're going to be able to take those the investment, build 4, 5, 6 car washes, and spend that $3 or $4 million per asset. Let's call it $5 to $6 million all in with the land. And right now they're selling for about $8 to $12 million, depending on the projected pro forma on the EBITDA over on a 3 to 5 year period of time. And you can actually sell it based on year 3 pro formas without even opening the doors, which is really, really cool. So because it's such a predictable model.
Sure. And who's the buyer in that sense? Given that this is still a very fractionalized space, in that scenario, who is the end buyer?
So for these, it's going to be us. So we're going to have a predetermined equity multiple based on the year 3 pro forma. That'll be an industry standard, normal kind of equity multiple, and we will actually buy those ourselves and then cash out the development investors.
Gotcha. No, makes sense. So outside of these various asset classes, or outside of real estate in general, are there any other places that you're deploying your own funds? And I guess the first thing that comes to mind, given that we've had such a crash, somewhat of a crypto crash over the last couple of days, are you in the crypto space or any other place that you're deploying capital?
Yes, I do have quite a bit in crypto, a little over 7 figures right now in crypto.
Yeah.
It might not be 7 figures at this point because of how crypto's been going, but most of my investment is actually on the mining side.
Gotcha.
So I've invested in some of my own machines, but also in some Bitcoin mining funds and stuff like that. So most of my capital is built up into mining, not necessarily just the crypto, but I do have some actual coins that I own, and so we don't have anything for our investors that we put together yet. And I did say yet, but we may or may not be working on it. And of course, whenever we research a new asset class, we never put our final like stamp of approval on it or okay until we know for sure we're going to do it. So right now we may do it, but it's also possible that we may not do it. So it just really depends. And I don't think right now is probably the best time to do one, just because of how crypto is tanked over the last probably 48 hours or so.
Yeah.
But that is definitely an asset class that we're looking at. And we also looking at medical office buildings and small light industrial as well.
Okay, fantastic. Guys, just to give you some context here, we're recording this on May 12th, and so it could be a couple of weeks until this comes out. So whether or not crypto's back at that point in time, who knows, right?
Hopefully it's back over 100,000 in a couple of weeks by the time this releases.
Yeah, well, good deal. Well, Dan, always good to catch up with you, my friend. Tell the listeners how they can get in touch with you. Where's the best place to find you and what you have going on?
Sure. Yeah. So there's a couple things you can do. So first off, if you're interested in looking at some of our offerings that we have in the future, obviously our website's passiveinvesting.com. There's a place on the website there to fill it out on the top right-hand corner, blue button to join our passive investor list, and one of our IR team members will reach out to you, discuss your investment goals, to see if you're a right fit for our group. If you want to follow me further or connect with me on LinkedIn, you can go to linkwithdan.com. That'll just bring you straight over to my LinkedIn profile. You can connect with with me there. And again, Kevin, thank you so much for having me on. I appreciate it. And let's not make it 3 years next time.
Yeah,
Okay.
I know, absolutely, my friend. And always a pleasure having you here. And guys, I appreciate you for joining us today. And until we meet again next week, just wishing you huge success and lots of cash flow. So you guys take care.